Home prices in the U.S. have continued to defy calls for a housing crash that never seems to materialize. In today's video, we're going to look at where the U.S. median home price is in the latest Redfin data, what's driving the latest price performance, and what it all means for real estate going forward. Let's get into it. The latest data from Redfin, a national real estate brokerage, shows the seasonally adjusted median home price in the U.S. came in at $414,000 in October, which was up 3.2% from the recent low point back in April. This price performance is in some ways mind-boggling given where affordability is right now. The average mortgage payment as a share of median household income reached 45% in October, the highest on record that I've tracked for this series. Last year, I thought we would see a much bigger correction in home prices due to record levels of unaffordability, but I underestimated the action on the supply side of the market. The same skyrocketing mortgage rates that deterred many buyers also kept a lot of sellers on the sidelines as well. So we had much fewer listings than we ordinarily would have had, and the low supply has kept upward pressure on prices. What we have in the market right now is a lot of pent-up supply and pent-up demand. Just look at what's happened with home sales. In a normal market, sales would trend higher over time, but they have basically collapsed in the last few years. All these homes that ordinarily would have sold here would have been off the market, meaning a lot of sellers and buyers have been on the sidelines. The pent-up demand is strong enough to absorb new listings on the market despite home prices and mortgage rates at the highest levels in years. This can be readily seen in the sales to list price ratio. While it is down from the pandemic peak of 102.4% back in March 2022, at 99.6% in October, this ratio is well above the pre-pandemic levels and nearly at 100, the point where homes are selling for list price on average. This is why prices are not coming down and are actually heading higher on a monthly basis. Recent trends for mortgage rates suggest this could continue. And we might start seeing a lot more activity in the U.S. housing market in the months to come. The average 30-year fixed-rate mortgage in the U.S. was 7.03% as of December 7th, down from the peak of 7.79%. Why is it going lower? The bond market is anticipating the Federal Reserve to start cutting rates next year, and as a result, the yield on the 10-year Treasury has been steadily heading lower since the middle of October. Why does this matter for mortgage rates, you might ask? The 30-year mortgage rate closely tracks the 10-year Treasury rate, so what happens in the bond market has the most direct impact on mortgage rates. The Federal Reserve will hold another meeting next week on December 12th and 13th, where they will decide what to do with their Fed funds rate, which influences other interest rates. The bond market's reaction to their decision, as well as Fed Chairman's comments on future action, will be key to watch. The Fed is widely expected to hold their Fed funds rate steady at that meeting. They will also be releasing their updated economic projections and their dot plot, which reflects where the board members estimate the Fed funds rate will be in the next few years. I'll be releasing a video at the end of next week to let you know what happens and what that will mean for the housing market. Make sure you're subscribed and hit that notification bell down below so you won't miss that video when it comes out. Based on current trends, things are likely to get better for real estate than worse in the months to come. Absent some kind of black swan event, the biggest risk to the housing market right now would be an economic recession, and I'm closely watching the economic data as well. We got new jobs numbers out this last Friday, and while growth has slowed, the economy is still adding jobs at a healthy pace, suggesting a recession is not on the immediate horizon. A recession would be a big hit to housing demand and put downward pressure on prices. I'll be releasing another economic outlook video on this channel in a few weeks to update you on where we are for that risk factor. Lots of good content coming. Make sure you're subscribed so you won't miss the latest forward-looking real estate analysis. And make sure to hit that like button on your way out to support the channel and help it grow. Thanks for stopping by. I'll see you in the next video.